Welcome to today's Explainer. Today we're going to do things a little differently with the numbers. We're looking at SSR mining, but we are completely skipping the dry, overly complex financial jargon. Instead, we're going to evaluate their raw data exactly like we were appraising a piece of real estate. I want you to think of yourself as a house hunter, walking up to a brand new property on the market. We really want to figure out, is this a steal, a trap, or maybe a long-term dream home?
So let's dive right into this central question. It perfectly frames the fascinating, kind of conflicting numbers we're seeing with SSR mining right now. Imagine you find this gorgeous house. It is stunning, but the seller wants way more than the neighborhood average. The catch? The seller is also handing over a property that is completely paid off, with zero underlying structural financial stress. Do you just walk away because of the asking price, or do you pay up for that total peace of mind? Keep that in the back of your head as we walk through this property together.
All right, first up on our tour is Section 1, the curb appeal, explosive growth.
In real estate, curb appeal is that flashy exterior that instantly draws buyers in, right? Well, in the financial world, curb appeal is momentum. Back in 2024, this property took a massive hit, suffering a painful 35% drop. The roof was leaking, the yard was an absolute mess. But then, wow, a massive renovation. 2025 brought a staggering 214% gain. And rolling into 2026 year-to-date, they've tacked another 33% on top of that. If you're driving by this house today, it literally looks like the hottest property on the block.
What's really wild here is the sheer momentum. We're talking about a 190% trailing 12-month return and a nearly 196% rebound from its 50-week low. I mean, this acts as the ultimate hype machine. It's the exact equivalent of a bidding war happening right out there on the front lawn. When retail investors see these kinds of numbers, FOMO, the fear of missing out, it kicks in hard. Everyone wants a piece of the house that just tripled in value. But hey, we're smart house hunters. We don't just look at the fresh paint, do we?
Which brings us to Section 2, the appraisal, price versus fair value.
We're stepping inside now. We're taking off our rose-colored glasses and we're bringing in the professional appraiser to see what this house is actually worth compared to its super lofty asking price. Out on the open market, the current asking price sits at $29.19 a share. That is the big, bold number right on the listing brochure. If you want to buy into SSR mining right this second, that's what the market demands you pay.
But the appraiser just handed us the clipboard. When we run the discounted cash flow metrics, which simply put, is just looking at all the cash this business will genuinely produce in the future and discounting it back to today's dollars, the appraised fair value of the underlying business is only $18.54. That is a massive disconnect between the hype going on out on the front lawn and the actual bricks and mortar reality of the business's earning power.
So this brings up an absolutely crucial point, understanding your margin of safety. In investing, exactly like in real estate, this is the discount you ideally want when buying an asset to protect yourself from risk. Think about it. If the appraiser says a house is worth $100 grand, a value investor wants to buy it for $70 grand. That $30,000 gap, that's your margin of safety, just in case the roof caves in or the appraiser was slightly off.
For SSR mining, this margin of safety is, well, it's a staggering negative 57.43%. Just let that sink in for a second. Buyers today are paying a massive, steep premium over what the strict mathematical discounted cash flow says this company is actually worth. You are paying nearly $30 for a property that, purely based on its current cash-generating ability, appraises at roughly $18.50. Normally, this is the exact moment a value-conscious house hunter turns around and walks right out the front door.
But wait, Section 3, the debt foundation. Let's look under the hood.
Before we completely walk away from an overpriced house, we absolutely have to inspect the foundation. Because sometimes, a premium price is justified if the bones are indestructible. Let's look at their debt-to-equity ratio. Having a high debt ratio is like having a heavy, suffocating mortgage that completely restricts your ability to build an extension or fix a broken furnace. But SSR mining, they have a debt-to-equity ratio of just 0.11. That is phenomenally low. In our real estate analogy, SSR mining basically owns its massive house outright. They have virtually zero mortgage. This gives the management team immense freedom and flexibility. If the market crashes tomorrow, they don't have massive interest payments dragging them underwater.
Moving right along to Section 4, cash flow and health. Let's check the plumbing.
We really need to ensure this house can sustain itself without needing constant expensive repairs that just drain the owner's bank account. Looking at their emergency fund, the metrics here are pristine. The current ratio sits at a very healthy 2.08. What this proves is that for every single dollar of short-term bills coming due over the next year, SSR Mining has over $2 of liquid assets readily available in the bank. Even their quick ratio, which strips out inventory and looks at only the absolute most liquid assets, is 1.25. If an unexpected storm hits, this house doesn't just survive. It sits comfortably with a massive cash buffer.
Furthermore, the pipes are flowing perfectly. SSR Mining is generating over $241 million in trailing 12-month free cash flow. Now, this is the unencumbered cash left over after paying all the bills and maintaining the property. We aren't talking about theoretical accounting profits here. This is cold, hard cash entering the house that can be used to buy more land, upgrade the facilities, or just return right back to the owners.
Add in an 8.22% return on invested capital, and we get the complete picture of how this property is being managed. When the company takes its money and builds a new addition onto our metaphorical house, they are getting a solid 8% return on that investment. We're looking at a management team that is actively, safely, and profitably upgrading the property, and it's all backed by a flawless balance sheet.
All right, Section 5, the final verdict. Let's step back, take a breath, review our inspection report, and really look at our core conflict here as an investor. On one hand, you have the hype, sky-high curb appeal with a 190% return driving the current asking price up to over $29. On the other hand, the reality of the appraisal. The actual cash flow math says the fair value is closer to $18.50, leaving you with a scary negative 57% margin of safety. But then you look at the foundation, a practically non-existent debt-to-equity ratio and a fortress-like current ratio. You essentially have an expensive market price completely detached from its current cash flow, but attached to a fundamentally bulletproof balance sheet.
Ultimately, any buyer evaluating SSR Mining has to confront this exact reality. You have to weigh the immediate financial pain of a 57% negative margin of safety against the incredible leverage, safety, and future growth potential of a completely debt-free foundation. If you buy in today, you're essentially betting that the pristine foundation and that $241 million in free cash flow will eventually grow the house's actual value to meet and hopefully exceed today's inflated asking price.
So, I'm going to leave you with this final thought to analyze as you look at your own portfolio. Are you willing to pay top dollar today, absorbing a massive premium, for a foundation so incredibly strong that it practically guarantees safety tomorrow? That is the SSR Mining dilemma in a nutshell. Thank you so much for joining me on this explainer. Keep questioning those numbers. Always look past the curve appeal, and I'll see you next time.